let's start the market minutes then, Mark, and to start the clock and think about where we are. Powell then talking about a measured pace, or suggesting a measured pace of rate hikes. Maybe that plays into Alan's point. I mean, he would go so far as to say central banks will let inflation rip. I know you take a different view, but certainly the Powell comments were supportive for risk assets in yesterday's session.
I think that's right. I think they showed they're supportive for two reasons. One was they're not completely asleep at the wheel. I think it would have worried markets if they said we might not hike at all, because inflation is the bigger, longer-term threat there. And I think they said they're ready to be nimble, and that is probably the best thing to deliver. That means they will react. They're not on a preset path, and that's why it reassured the market. I do agree with Alan that central banks are trying to stay behind the curve, but they've been behind the curve for too long. They risk losing control of the narrative, just like the 70s, and the longer they do that, the more likely we need a shock like a Volcker shock to regain control of the narrative. And I hope we don't get to that route.
Okay, and he described it nicely. He said that the interest rate sensitivity for the markets is higher, but the energy sensitivity is lower. But we still focus on the commodity story because there is so much movement taking place there at $116 a barrel on Brent right now. Self-sanctioning, so much self-sanctioning going on, whether in all kinds of parts of the commodities markets, it would seem, from shipping companies to insurance companies, so much uncertainty. I wonder if we need some further clarity on what is and is not sanctioned, whether that is helpful at this point from governments around the world.
That's absolutely right, Anna. So Alan made a very good point. Equity markets are much less equity intensive now. The economy is much less equity intensive, and that is correct. However, we are in a pretty incredible commodity situation, and it's not just energy. 70s was about an oil price shock, and that obviously fed through to other commodities. But we have a major food price problem right here as well, and that is quite dramatic because it is really hurts consumers, particularly at the lower end of the income train. So I think the commodity shock now is particularly alarming, and that's why we should be worried, and that's where the transmission comes through to interest rates, and that's why we're going to be more sensitive this time around.
And you've certainly made the point in the past that we need to watch that in terms of other new geopolitical developments and violence, possibly. There has been a link between higher food prices and that in the past. You talked about how, as tragic as the events are, and of course they are in Ukraine, that US stocks maybe reacted too much to that. Maybe that wasn't a good reason for selling US stocks, but you see other global stocks as exposed.
Absolutely. I think US stocks can have a little bit of upside in the short term, but longer term they have a problem due to inflation, and India is the other probably most vulnerable stock market out there.
Okay, remember you can get up-to-date analysis and insight from Mark and the rest of the Markets Live team. MLIV GO is the function to use on your terminal.